I need to tell you about something that keeps me awake at night. Not because I'm worried about my own money. I manage over $11 trillion. I've built systems and processes that have survived every crisis since 1988. What keeps me awake is thinking about the individual investor, someone who has worked for 40 years, saved diligently, done everything right, and then retires at exactly the wrong moment. They walk into retirement with $1 million in savings, and 5 years later, through no fault of their own, they're in serious trouble. I've watched this happen. I watched it destroy lives in 2008. I saw retirees who had everything they needed on paper, but because they retired in 2007, because they entered the distribution phase just as the market collapsed, they never recovered. They did nothing wrong. They didn't panic. They didn't chase speculation. They simply had the misfortune of bad timing. And that bad timing cost them their security. This is what we call sequence of returns risk. Most people have never heard this term, but it's one of the most dangerous threats a retiree faces. Let me explain what it means and why it matters so much. When you're working and accumulating wealth, the order of your returns doesn't matter much. If you have a bad year followed by a good year, or a good year followed by a bad year, the long-term result is roughly the same. You're adding money consistently. You're not withdrawing. Time smooths out the volatility. But the moment you retire, the moment you start taking money out of your portfolio to live on, the mathematics change completely. Suddenly, the sequence of returns, the order in which you experience good years and bad years, becomes critical. Here's a simple example that illustrates the problem. Imagine two people. Both retire with $1 million. Both experience the exact same returns over 30 years. The average annual return for both is 7%. But person A experiences terrible returns in the first 5 years of retirement. The market crashes, recovers slowly. Person B experiences great returns in the first 5 years, then hits the same crash later. Same average return over 30 years. But person A runs out of money by age 80. Person B dies wealthy with money left over. Same returns, opposite outcomes. The only difference was the sequence. Why does this happen? Because when you're withdrawing money during a downturn, you're selling shares at depressed prices. You're locking in losses. You're reducing the number of shares you own permanently. So when the market recovers, you have fewer shares participating in that recovery. You've dug a hole that you mathematically cannot climb out of, even if the market goes on to perform well for the next 20 years. I've sat across from people in their 70s who understood this too late. They came to me with portfolios that had decent long-term returns on paper, but they'd been forced to sell during the 2008 crisis to pay for living expenses. They sold at the bottom, and even though the market doubled by 2013, they didn't participate in that recovery because they'd already liquidated so much of their position. The wealth they should have had, the retirement they'd planned for, was gone. Not because the market failed, not because they made bad investment choices, but because the crash happened at the worst possible time in their personal financial life cycle. This is the nightmare scenario. And it's not rare. It's not some statistical outlier. It happens to a significant percentage of retirees who have the bad luck to retire into a bear market. So what do you do about it? How do you protect yourself from something that feels like pure chance, pure bad timing? That's what I want to talk about today. 4 specific moves that can insulate your retirement from sequence of returns risk. These are not complex. They don't require you to time the market or predict the future. They're structural decisions, defensive architecture that institutions have used for decades. And if you implement them before you retire or early in your retirement, you dramatically increase your odds of financial survival, no matter when the next crash comes. Move number 1. Build a bond ladder for your near-term expenses. This is the most important defense against sequence risk. And it's surprisingly simple. You take 1 to 5 years of your living expenses, and you set that money aside in short-term, high-quality bonds, not stocks, not long-term bonds. Short-term bonds are treasury bills that mature in 1, 2, 3, 4, and 5 years. This is your safety net. This is your buffer. Here's why this works. When the stock market crashes, you don't have to sell stocks. You have 1 to 5 years of expenses already set aside in stable, liquid, low volatility instruments. You can let the stock market do whatever it's going to do. It can fall 40%, 50%. You don't care. You're not selling. You're living off your bond ladder. You're giving your stocks time to recover before you have to touch them. Let me give you a concrete example. Let's say you need $50,000 a year to live on. You would set aside $250,000 in a bond ladder, $50,000 maturing in year 1, $50,000 in year 2, and so on. In year 1 of your retirement, you live off the bonds maturing that year. You don't touch your stocks. In year 2, same thing. If the stock market crashes during this period, you're insulated. You're not forced to sell. You can wait. You can be patient. And here's the key insight. If you give a diversified stock portfolio 5 years to recover from a crash, history shows it almost always does. The 2008 crisis, stocks recovered in 5 years. The 2020 pandemic crash, stocks recovered in 5 months. The 2000 dot-com crash took longer, closer to 7 years, but even that eventually came back. The point is, if you're not forced to sell during the downturn, if you have a cushion that lets you wait, you avoid locking in the losses. You avoid the death spiral of selling at the bottom. Now, I know what some people will say. They'll say, but bonds yield less than stocks. If I keep so much money in bonds, I'm giving up growth. I'm being too conservative. And my answer is this: you're not giving up growth. You're buying insurance. This bond ladder is not your growth engine. Your stocks are your growth engine. The bond ladder exists for one reason only: to make sure you never have to sell stocks during a crash. That's it. That's its entire purpose. And the cost of that insurance, the slightly lower return on the bond portion, is trivial compared to the catastrophic cost of being forced to liquidate equities at a market bottom. At BlackRock, when we manage money for pension funds, we call this liability matching. We structure the portfolio so that near-term obligations are covered by stable, predictable assets. We don't take risks with money that's needed in the next few years. Only money that can stay invested for a decade or more goes into higher risk, higher return assets. This is basic institutional portfolio management, and individual retirees should do the same thing. Move number 2. Use a dynamic withdrawal strategy, not a fixed rule. Most people have heard of the 4% rule. You retire with $1 million. You withdraw 4%, $40,000 in year 1. Then you adjust that $40,000 for inflation every year. It's a simple rule, and for many years it was considered safe. Studies showed it had about a 90 to 95% success rate over 30-year retirements. But the 4% rule has a major flaw. It's rigid. It doesn't adapt to market conditions. In a year when your portfolio is up 20%, you're still only withdrawing 4%. And in a year when your portfolio is down 30%, you're still withdrawing 4%, or actually more in real terms because you're adjusting for inflation. This rigidity is dangerous. It forces you to take the same amount of money out, regardless of whether it's a good time or a terrible time to sell. Better approach is what I call dynamic withdrawal. You adjust your spending based on portfolio performance. In years when the market is up, when your portfolio has grown, you can afford to take a little more, maybe 4.5%, maybe 5%. You take that vacation you've been planning. You enjoy the good years, but in years when the market is down, you tighten your belt. You cut discretionary spending. You withdraw 3%, maybe 3.5%. You give the portfolio breathing room to recover. This flexibility, this willingness to adjust your lifestyle, modestly based on market conditions, it dramatically improves your portfolio's longevity. Studies show that dynamic withdrawal strategies can push success rates up to 98 or 99% over 30 years. That's a massive improvement just from being a little bit flexible. Now, I understand this requires discipline. It requires you to distinguish between essential expenses and discretionary expenses. You need to know what you absolutely must spend on housing, healthcare, food, and what's optional: travel, entertainment, gifts. But this is the kind of thinking that successful long-term investors do. They adapt. They don't rigidly follow a rule that was designed for average conditions. They respond intelligently to the reality they're facing. And let me be very clear about something. I'm not asking you to live like a monk. I'm not asking you to suffer. I'm asking you to be strategic. In good years, live well. In bad years, live a little more modestly. That's not sacrifice. That's wisdom. Move number 3. Allocate a portion of your portfolio to inflation-protected securities. This is where tips come in. Treasury inflation-protected securities. These are bonds issued by the U.S. government where the principal adjusts based on inflation. If inflation is 3% in a given year, the value of your tips goes up by 3%, and you earn interest on top of that inflation-adjusted principal. Why does this matter for sequence risk? Because one of the worst scenarios you can face is high inflation combined with a stock market crash. This happened in the 1970s. Stocks were flat or down for a decade, and inflation was running at 8, 10, 12%. People who retired during that period and held only stocks and traditional bonds got destroyed. Their purchasing power evaporated. Tips: protect you from this scenario. They guarantee that your real purchasing power, your ability to buy goods and services, is preserved no matter what happens to inflation. And this gives you stability. It gives you a floor. It means that even in the worst-case scenario, high inflation and poor stock returns, you still have a chunk of your portfolio that's keeping pace. I generally recommend that retirees allocate 10 to 20% of their portfolio to tips, not the whole portfolio. You still need stocks for growth. You still need other bonds for liquidity. But that 10 to 20% tips allocation acts as a hedge. It's insurance against the inflation risk that traditional bonds don't protect you from. And here's another benefit of tips that people overlook. They reduce anxiety. When you know that a portion of your wealth is explicitly protected from inflation, you sleep better. You're less likely to panic during volatile markets. You have that psychological cushion that allows you to stick to your long-term plan. Move number 4. Implement a bucket strategy. This is a framework that ties everything together. The bucket strategy divides your portfolio into 3 buckets based on time horizon. Bucket 1 is your cash and near-term bonds, 1 to 3 years of expenses. This is your immediate liquidity. Bucket 2 is your intermediate-term investments, maybe 4 to 10 years out. This could be a mix of bonds, dividend-paying stocks, REITs, things that are relatively stable but offer some growth. Bucket 3 is your long-term growth assets. Stocks, equity index funds, maybe some allocation to private markets if you have access. This money doesn't get touched for 10, 15, 20 years. The beauty of the bucket strategy is that it gives you a clear roadmap. In any given year, you're only drawing from bucket 1. You're only spending the money that's already in cash or very short-term bonds. You're never forced to sell bucket 2 or bucket 3 during a downturn. And as bucket 1 depletes, you refill it from bucket 2 during good years, when markets are up. And you refill bucket 2 from bucket 3 the same way. You're always moving money from riskier buckets to safer buckets. When conditions are favorable, never when they're terrible. This approach completely eliminates the sequence risk problem because you're never selling stocks when they're down. You're always selling stocks when they're up, or at least stable. And that means you're never locking in losses. You're never destroying your share count at the worst possible moment. I've seen this strategy work in every kind of market environment. I've seen it work through crashes, through corrections, through prolonged bear markets. It works because it's based on a simple principle. Don't sell what's down, only sell what's up. And structure your portfolio so that you always have something to sell that's up, or at least stable. Now let me address the question that's probably on your mind. How do you know if you need to worry about sequence risk? How do you know if you're vulnerable? Here's a simple test. Look at your portfolio. If you retired in the last 5 years, or if you're planning to retire in the next 2 years, and more than 70% of your portfolio is in stocks, you're exposed if you don't have at least 3 years of living expenses in stable liquid assets. You're exposed. If you're planning to withdraw 4 or 5% a year and you have no flexibility to reduce that in a down market, you're exposed. And if any of those things are true, you need to make changes now, not next year, not after you see how the market performs. Now, because by the time the crash happens, it's too late. The damage is done. You can't go back in time and build your bond ladder. You can't go back and create your bucket structure. You have to do it before the storm hits. I've managed money through 6 major crises in my career. The crash of 1987, the savings and loan crisis, the dot-com bubble, September 11th, the 2008 financial crisis, the pandemic, and I can tell you with absolute certainty that the people who survive these crises, the people who come out the other side, not just okay but stronger, are the people who prepared in advance. They're the people who built defensive structures when times were good. They're the people who didn't assume that good markets would last forever. The ones who get hurt are the ones who wait. The ones who say, "I'll deal with it when it happens." The ones who think they can react fast enough once the crash starts. You can't, no one can. By the time you realize the market is in free fall, it's already down 20–30%. And if you're a retiree pulling money out, that 20 or 30% drop can be terminal. So build your defenses now. Build your bond ladder. Implement dynamic withdrawals. Add tips to your allocation. Set up your bucket structure. These are not complicated moves. They don't require you to be a financial genius. They just require you to think ahead. They require you to acknowledge that bad times will come and to prepare accordingly. And here's what's interesting. Once you've built these defenses, once you've insulated yourself from sequence risk, you actually become a better investor because you're no longer afraid. You're no longer checking your portfolio every day, worrying about the next downturn. You know you're protected. You know that even if the market crashes tomorrow, you have 5 years of expenses covered. You're not going to be forced to sell. And that psychological freedom allows you to stay invested in equities for the long term. It allows you to capture the growth that stocks provide over decades. It allows you to be patient. This is the paradox. The investors who are most defensive in their structure are often the most aggressive in their long-term allocation because they've separated short-term safety from long-term growth. They've built a system that lets them do both. I think about retirement as a 30-year project, maybe longer. If you retire at 65 and live to 95, that's 30 years. That's not a short period. That's long enough to experience multiple market cycles, multiple recessions, multiple crises, and your portfolio has to be built to survive all of it. Not just the good times, not just the average times, the truly terrible times. Sequence of returns risk is the hidden killer. It's the risk that most people don't think about until it's too late. But now you know. Now you understand how it works and how to defend against it. You have 4 moves: bond ladder for near-term expenses, dynamic withdrawal strategy, TIPS allocation for inflation protection, bucket structure for systematic safety. Implement these moves and you transform your retirement from a gamble on timing into a structured plan that works in any environment. You stop relying on luck. You start relying on architecture. And that's the difference between hoping your retirement works out and knowing it will. I've spent 40 years learning these lessons. I've seen what works and what doesn't. I've seen the mistakes that destroy retirements and the strategies that preserve them. This is not theory. This is the accumulated wisdom of managing trillions of dollars through every conceivable market condition. And I'm telling you, if you're approaching retirement or already in retirement, these 4 moves are not optional. They're essential. They're the difference between security and catastrophe. Build your defenses. Protect what you've spent your life building, because the storm will come. It always does. The only question is whether you'll be ready.